there, Rose Jacobs with you for Kalkine, and in this video we'll take a look at ETFs versus stocks and the best way for you to invest for growth. But first, make sure to subscribe to the channel and press the bell icon to stay across the latest videos from Kalkine. Investing in stocks is like an art form, which if executed well can help investors enrich their coffers. By choosing the right options and employing sound investment strategies, investors can potentially turn $10,000 into $500,000 over time. However, investors also need to be mindful of the fact that stock markets are prone to be volatile at times. The high-flying stocks piquing your curiosity could be weak in terms of fundamentals and may turn out to be a loss-making affair in the long run. Then there are exchange-traded funds, ETFs. An ETF is a type of investment fund that is traded on stock exchanges. They hold similarity to mutual funds in some ways, except that these funds are purchased and sold throughout the day on stock exchanges. However, mutual funds are purchased and sold based on their price at the end of the day. Both investing strategies can be wonderful options depending on investor to investor. So, if you're confused whether to buy stocks or ETFs, here are some points that you should really consider. 1. Are you ready for a detailed research? Research plays an important role when deciding between stocks and ETFs. Stocks require more detailed research than ETFs. Investors need to be doubly sure about the quality of stocks being included in their investment portfolio because the returns depend on their stock selection to a large extent. In the case of ETFs, you invest in one ETF and end up automatically investing in all the stocks included in that fund. So, stocks are more research-oriented than ETFs. How much do you want from your portfolio? Investors are in the higher control seat when it comes to individual stocks rather than the stocks owned through ETFs. So, individual stocks are a good idea for investors seeking complete control over their investment. ETFs may work just fine if a highly personalised portfolio isn't at the top of your priority list. With individual stocks, you are free to sell them any time down the line or rebalance your portfolio. However, it's not that flexible with ETFs since someone else is managing that fund for you. But this doesn't mean that ETFs don't stack up against stocks. There are several examples from the global markets where ETFs have given solid returns to investors for a very consistent period of time. For instance, the S&P 500 ETF is considered a fairly safe investment. It's known to have given an average rate of return of nearly 10% per annum, which is a good enough scenario. The bottom line is that ETFs generally require an investor to invest regularly without thinking about it for a long time. The fund is capable enough to take care of the rest. On the other hand, individual stocks require detailed research, as we discussed earlier. You need to be relatively active when dealing with stocks so that they don't lose their worth over time. Holding stocks for the long term is critical for building that long-term wealth. If you enjoyed the information contained in this video today, then make sure to like, share, comment and subscribe. And don't forget to press that bell icon to stay across all the latest videos. For more information, you can head across to kalkinemedia.com. I'm Rose Jacobs for Kalkine.